You capitalize the property, plant, equipment in balance sheet under non-current assets. But how do you expense it out? And with so many depreciation methods out there, which one would you choose? Also, what is residual value? Stick around to find out. What causes depreciation? Now, depreciation is the decrease in value of the asset due to normal wear and tear during the use. No matter how careful a driver you are, the parts will wear out with use, or they may catch rust, or the technology become obsolete and the part may not be available after 5 years. So let's assume that the car has a useful life of 5 years. This means that the asset can be charged a depreciation of 20% per annum on straight line basis method. Net book value is the cost of the asset less accumulated depreciation at the end of the accounting period. Let's say the cost of vehicle is $5,000, depreciation for year one is $1,000, and the NBV is $4,000. Depreciation for year two is $1,000 again, and the NBV is $3,000. Continuing the series, the NBV at the start of year five would be $1,000, depreciation for year five is $1,000, and the NBV is $0. Now, this means that the asset is fully depreciated at the end of the useful life in straight line basis method. That may be the case when there is a regulatory requirement to scrap the asset after 5 years. It's really the case for most assets in life. If you look at the local car listing, you'll find that a year-old vehicle is listed for $4,350. 2-year vehicle is listed for $4,150, and 3-year vehicle is listed for $4,000. Now, the above price may be reflective of a lot of factors, but one thing is for sure, there is no straight line depreciation in most cases in life. So, we offer a slightly modified depreciation method. Instead of charging percentage depreciation on the cost of the asset, we charge percentage depreciation on net book value of the assets. Let's say, again, the cost of a vehicle is $5,000. Depreciation for year one is again $1,000, NBV is $4,000. Instead of charging 20% on the actual cost, which is $5,000, now you charge 20% depreciation on the net book value of the asset. Depreciation for the year would be $800, and the NBV is $3,200. Continuing the series, the NBV at the start of year 5 is $2,048, and depreciation for year 5 is $410, and the NBV is $1,638. Although the asset have gone through its entire useful life, the NBV is not zero. There is always a scrap value of asset, no matter how insignificant it is. There's a new car in the market, and the brochure says all the great things about it. Pretentious stuff mainly. Oh, it's the best vehicle we've made to date. However, in the fine print, you find that the car can only do 100,000 miles. No matter what you do, it won't work after that. Now, we changed the depreciation method a bit. It's the same as straight line method with a minor tweak. And instead of life being measured in years, now you measure the life in miles. For every 10,000 miles, you charge a depreciation of 10%. The cost of the asset is $10,000. Depreciation for the first 10,000 miles is $1,000. The series continues till the end of 100,000 miles, where the NBV is 0 again, just like the straight line basis method. Residual value is the assumed scrap value that is left at the end of the useful life. Let's say that the asset has a residual value of 20%, that is $1,000. The accumulated depreciation at the end of the useful life is $4,000 against a cost of $5,000, resulting in a residual value of $1,000.